Hi there guys, Paul from Paul de Klerk and Associates, and today we are talking about life insurance and the things that you need to know to have a successful life insurance policy that works. Now you might think to yourself though, Paul, it's life insurance. You die and you get money. What else is there? Turns out there's a little bit more to it than that, and I'm going to discuss the 4 components of a successful life insurance policy. Okay, so there are 4 components to a successful life insurance policy. So that's 4 things that you need to think about if you're going to have a life insurance policy that actually works for you. Number 1, you're going to have the insured. Number 2, you're going to have the benefit. Number 3, you have the owner. And number 4, there is the structure of the policy to consider. Now let's just talk about each one of these very quickly. The insured is the person that if they die, right, their life is the one that's being insured. That can be a mother, a father, a business owner, something like this. The benefit, that refers to the amount of money that's attached to the policy that will pay out if the insured dies. The owner, that is the person who owns the policy. The owner of the policy is the one that receives the life insurance money. It's something that not a lot of people think about, right? Especially if they're trying to do this for the first time, but we'll explain more. The structure, this refers to how the life insurance money is going to pay out, because not all life insurance policies pay out in just one big lump sum hit. There's a little bit more to it than that, and there's some nice ways you could possibly save some money. So you've got the insured, the benefit, the owner, and the structure. Okay, so it's pretty simple so far, right? But I want to explain a little bit more, because the whole point of life insurance is that the right person receives the right amount of money, right? And this is something that's extremely important to get right. But first, let's talk about the benefit. This is the amount of money that needs to pay out. Now, different advisors can have very different opinions on what to do here. But for me, most of my clients don't have very big levels of debt. Things like mortgages and really big things like that. They might have something like a car that they're paying off or some credit cards, but most of the time it's the income that they are trying to secure for the family. That is to say, if the insured person dies, that would be a mother or a father or a business owner. If they die, let's just try to figure out how much income is the family or the business going to miss out on if that person dies, and that will be then the benefit that we would try to insure for as much as what the budget allows. But then, to whom must the benefit go? And that would be the owner. Again, it can be a business or a person, but the owner should specifically be listed on the policy. And I see it all the time, especially with bank policies that I see, that they specify the insured and they specify the benefit, but the insured becomes the owner as well. This is not a good idea if the purpose is to leave money for your family afterwards, because if the insured is also the owner, right, then who's going to get the money? The insured. But where's the insured? Well, they're under the ground, they died. The money is going to be paying out to an estate, and you can wait many, many, many months for that money to pass through probate, to end up in the hands of the mother or father or family member for the sake of the children. Not a good idea. If you're a normal mum and dad out there trying to provide money for the surviving spouse, make sure that both of you are going to be owners, and then there's no worries at all. Okay, there's just one more thing that I would like to talk about, and that is the structure of the policy, because there's actually more than one way to get the money paid out. Most people understand the traditional lump sum policy, right? Most of the time I would see a life insurance policy get together. There's $100,000, $300,000, $1 million worth of lump sum that pays out to the family. There is a way as well, instead of getting a lump sum payout, you can have monthly payouts that pay out over time, say 15 years or so. And remember, this is all tax-free as well. But if you're trying to protect your income, there is the option of having your life insurance pay out a monthly sum. So that's the things that you need to know about life insurance though. Who's going to be insured? For how much are they going to be insured? who's going to get the money and how do you want it to pay out. And a big lump sum hit because you have some debts like mortgages, and then can the family get a monthly payout over time so that they can keep on paying their bills after you as the insured are gone. That's really it. If you have any questions, guys, flick me a message. I'm here all the time, happy to help. Thanks for listening.